here. And the society is out of control in the battle for the soul of capitalism. I talk about the frightening similarities between the American economy, America, our nation, at the beginning of the 21st century, and Rome, all those centuries ago, around the 4th century.
What are the comparisons?
We have an idea that we are the world's value creator and leader, and I'm talking not just about economic value, but we like to think of America as having the best values of integrity and citizenship in the world. We're getting a little bit too much self-interested. We have our own bread and circuses. They're a little different than the bread and circuses they had in Rome, but we surely have our circuses, whether it's sports teams or casino gambling or the lottery in the States. And you see this not just in our economy and in our financial system, this very short-term focus on everything. You see it, sadly, in our government. Everybody knows Social Security is going to run into crisis. We can't run these federal deficits forever, but everybody looks out 2 years and says, will I be elected 2 years from now or a year and a half from now? And the short-term focus ultimately betrays the very values that we have come to be used to in this great nation of ours.
You said the other day to someone that we think we can fight the war in Iraq without paying for it.
Well, we borrow the money to fight that. The Iraq war, by some estimates, and they're not absurd estimates, is running now toward $1 trillion. And we could be doing what the British Empire did, and we could be bankrupting ourselves in the long run. And
you see us as an empire?
Well, of course it's an empire. We reach all over the world. We've thought of ourselves in many, many respects as the policemen of the world. God knows we know we're the policemen of the Middle East. And there are those that say, even from Alan Greenspan on up or down, that oil is the root of that. I mean, these are great societal questions. Protecting oil, which is in turn polluting the atmosphere. We have problems as a society, and we don't have to surrender to them, but we have to have a little introspection about where we are in America today. We've got to think through these things. We've got to develop a political system that is not driven by money. I mean, these are societal problems for us that don't have any easy answers. But you don't have to be an economist to know that a great deal of momentum in our economy is coming from borrowed money. People are spending at a higher rate than they're earning, and we're starting to pay a price for that now, particularly in the mortgage side. But eventually that could easily spread, and people won't be able to do that any longer. You can't keep spending money you don't have. It gets a lot of it, you know. It wasn't that many years ago, maybe a couple of generations ago, that if you wanted something, you saved for it. And when you completed saving for it, you bought it. Imagine that. And that wasn't so bad, but now we know that we can have the instant gratification and pay for it with interest payments, and of course over time, which is not an unfair way to do it. We're going to pay a big price for the excessive debt we've accumulated in this society, both on the public side and the private side. And it's no secret that this lack of savings in our economy, they're just about zero, is putting us at the mercy of foreign countries. China owns, I don't know the exact number, but let me say 25% of our federal debt. China does. What happens when they start to buy our corporations with all those extra dollars they've got there? I mean, I think these problems are long-term, very much worrisome, and very much intractable. I want to come back to the difference between the financial system and the productive system. The productive system adds to the value in our economy, and by and large the financial system subtracts, and yet it's growing and growing and growing in this short-term thing, where short-term orientation in which trading pieces of paper is regarded as a social value. It is not a social value. Some of it has to happen, don't mistake me, right, but not as much as we have.
What does it say to you that people seem so indifferent to the fact that 1/10 of 1% of the population owns most of the wealth in this country?
Well, in the long run, I believe it's unsustainable. This is not going to be, a country like France, say at the time of, before the French Revolution, the lords of France, the kings, had probably the same kind of distribution of wealth we had today, come by through long generations. Their own castles, we have those castles in America now, but it says to me that in this society it's not sustainable. There will be an outcry.
Do we need new rules?
One thing is, I believe, to have a federal standard of fiduciary duty for money managers. They've come from 8% ownership of American business to 74% ownership of American business. A staggering, unbelievable change without any rules as to how they're supposed to behave. We have state laws of prudent investing and fiduciary duty and things of that nature, but they don't seem to be working. And our founding fathers actually thought about having a federal statute, a federal corporate chartering statute. I think we probably need one, because if some of the states step up and say improve their governance provisions, corporations will move to another state. So the state system, I don't think, can prevail. So federal standard of fiduciary duty, which demands that our pension trustees and our mutual fund directors make sure that those pension funds and mutual funds are operated in the prime interest of those who have entrusted their money to them. And that includes responsibility for corporate governance, and will ultimately turn to be, they'll focus more on long-term investing. When I came into this business in the 1950s, it was a business focused on the wisdom of long-term investing. We've changed in that period from a business that is focused on the folly of short-term speculation. The other part of it is, and this is really makes it a very difficult problem to solve, and that is a little bit out of, I guess it's pogo. We have met the enemy and they are us. These mutual fund companies, these management companies, are now owned largely by corporate America or international corporations. Deutsche Bank, AXA, big international companies who have bought their way into the U.S. financial system, which is, I don't mean to demean that, but they own these these public corporations, giant public corporations, life insurance companies, big banks, foreign insurance companies and banks own 41 of the 50 largest mutual fund managers. Now, what is the job of a corporation when they buy into a mutual fund management company? It's to earn a return on the capital they invest in that company. It's not to earn a return on the capital of the investors who invested with that mutual fund. Now, in fairness, they want to earn as much money as they can for the fund shareholders, but not at their own expense. What we've done is have what I call in the book a pathological mutation in capitalism, from that old traditional owner's capitalism to a new form of capitalism, which is manager's capitalism, where the evidence is quite compelling that today corporations are run in a very important way to maximize the returns of its managers at the expense of its stockholders.
It's CEOs.
It's CEOs, well, at the upper level, the five or six top officers. And they get enormous amounts of pay for actually doing very little. I'm a businessman. You know, we chief executives get an awful lot of credit that we don't deserve. Real work in companies is done by the people who are getting themselves together and doing the hard work of making companies grow.
And yet these are the people who most often get laid off, right?
They get laid off, and of course the ironic part of that is they often get laid off. It used to be called downsizing, but of course in today's America it's called right-sizing. They get laid off. That reduces expenses, that increases earnings, and that means the CEO gets more. Just think about the country for a minute. We're an agricultural economy, 95%, 98% agricultural when this country came into existence. And even by 1850, half agricultural. Now it's about, we've moved from an agricultural economy to a manufacturing economy, to a service economy, and now to a financial service economy. And the financial service economy is what troubles me, because it's diverting resources from the investors to the capitalists, to the entrepreneurs, to Wall Street, to the investment bankers, to hedge fund managers, to mutual fund managers. And that is a negative to our societal values, where agriculture and manufacturing and services, I mean, I'm perfectly willing to give a high value, for example, to art and poetry and literature. They add value to our society. It may not be easy to measure it in a society that measures too much of what's not important and not enough of what is important. As the sign in Einstein's office says, there are some things that count that can't be counted, and some things that can be counted that don't count.